Hi friends, welcome to the part 2 lecture of unit number 27 of BFM. Here we are starting with internal control, which is the first part. This is the part where we have left in the last session. So let's start with the internal control, basically what it means. So it means that banks should have independent teams that regularly check and verify risk data. So here is the key point, independent teams, right? That should regularly check and verify risk data. So it means independent teams. Now the second question is why these independent teams are needed. The first reason is accuracy. You know accuracy, that means the data reflect real financial risk. Second, effective reporting. It means that important updates like some breach limits are reported immediately. That is called effective reporting. That is why internal control is required. The third reason is independence. Means the risk management team must be separate from the profit making department. You can see two parts. The first one part is risk management team, and other is the profit making department, right? So risk management team must be separate from the profit making department, right? So this is the third part. So three part I have talked about. Why we need this internal control? The three reason is accuracy, effective reporting, and independence, right? Now let me give you an example. Imagine if the loan department also control risk reporting, wouldn't they hide bad loan? Suppose the loan department is also controlling the risk reporting. There is the loan department, right? And this loan department is also controlling the risk reporting. So would not they hide bad loan? That is why risk management must be independent. So this is very important. Why risk management is independent? That is what I am telling you. Because suppose the loan department is also controlling the risk reporting. So what will happen? Ultimately, they will hide the bad loan. That is why risk management should be independent. I hope this make you concept clear. Now let's talk about submitting the ICAAP outcome, why it is important. So but wait, tracking risk is not enough. Bank need to document everything, right? We are tracking risk, all right, very nice, but bank need to document everything, right? And after documenting, they should submit report to the regulators. So before that, first understand what is this ICAAP. What is this ICAAP? Let's understand it. Friends, it is an ongoing risk management process that bank must document and submit to RBI regularly. So here is the key point, ongoing process, right? Ongoing which kind of process? Ongoing risk assessment process, okay? And it should be submitted to RBI, you can see, in periodic, in prescribed format, in regular interval, right? So why, what does it ensure? So this ensures that bank is financially strong, right? If this is an ongoing process, we submit to RBI regularly, and what it ensures? It ensures that bank is financially strong, right? It ensures that bank is financially strong and has enough capital to cover risk. So two things I am talking about. First thing is financially strong, and second thing is enough capital to cover the risk, right? So the next question is, why does it matter? Because you know, it keeps bank accountable, right? It keeps bank accountable. The first reason is, why does it matter? The reason being that it keeps bank accountable, and the second reason is that it ensures regulator can step in if risk go out of control, right? Suppose risk go out of control, then in that case, you know, that regulators can step in. So the key takeaway from this discussion is that, a bank risk strategy is not about tracking, it is about regularly reporting and improving. So let me write down the two key points. The first point is reporting, right? And plus reporting and improving its financial safety net. That is what the role of bank risk strategy. So what did we learn till now? We have learned that internal control ensure accuracy and prevent conflict of interest, and ICAAP report must be regularly submitted to RBI for accountability. So question may be asked, to whom this ICAAP report must be submitted? The answer is RBI. Okay, I hope this make you concept clear. Now let's talk about the next part that we have. The next point is, okay, so next point is regarding ICAAP implementation, right? So so you can see ICAAP implementation guideline based on complexities of bank activity. So this is what we are going to discuss now. So ever wondered how bank prepare for financial shock? What if a bank suddenly face huge loss? How does it stay stable? That is where ICAAP comes in picture. Let's break it down in the simplest way for your CIB examination. So now the first thing is that ICAAP implementation different approach for different banks, right? So bank don't all work the same way. A small bank giving loan to local business don't face the same risk as a large multinational bank trading in complex financial instrument. That is why ICAAP implementation depends on how simple or how complex the bank activities are. So see, it simply depends on the complexity of activity. That is what I'm telling you. So you take two type of bank: a local bank, right? A local bank, a small bank giving loans to local business. So it does not face the same risk as a large multinational bank, isn't it? So a small local bank, the risk faced by a small local bank is not the same as a large multinational bank trading in complex financial instrument. That is why this ICAAP implementation, it depends on how simple or complex the bank activities are, or we can say complexities of bank activity. Let's see how bank of different size handle it. So first of all, let's discuss ICAAP for bank with simple activity. Let's discuss it now. For bank with simple activity. So think of a small bank as a small grocery store. The risks are straightforward: cash flow, inventory, and customer payment, right? So for bank with simple activity, straightforward risks are there, right? A small bank focus on these key areas. So what are the key area? The first key area is largest loss. That means learn from the past loss. What it means? That it means that the bank looks at its biggest financial loss over the last 3 to 5 years. What were the largest loss over the last 3 to 5 years? The bank look at. Now why does it look at it? The reason is that to understand what went wrong and how likely it is to happen again. For example, if the bank lost money due to bad loans, suppose the bank lost money due to bad loans, right? So it will analyze which loan failed and why. So this is called the first step, that is called identifying the largest loss. Then the next thing they check as is checking the capital absorption. What it means? It means that bank ask, do we have enough capital to absorb losses if this risk actually happen? So the risk which we are talking about, which happened in the last, the losses which happened in the last 3 to 5 years. So obviously they are risk. So suppose this risk happen again, this losses happen again. So do we have capital to absorb the loss? For example, suppose a major borrower default, will the bank still be financially stable? That is called capital absorption, checking capital absorption. So the first thing they do is to identify the largest loss. Second thing they do is the checking the capital absorption. And the third thing they do is called scenario analysis or scenario planning. This is the third thing they do. I mean talking about bank, right? So what it means, the bank, so scenario planning means what? The bank run what if scenario. What they run? They run what if scenario to see how risk might impact its finance over the next 3 to 5 years. For example, what happen if the interest rate suddenly rise? Will the loan repayment slow down? That is called what if scenario. And finally, they document the capital ranges. They document the capital needs. It means that bank create a detailed report on how much capital it needs to stay secure and get senior management approval, right? So get approval of senior management regarding this. So the key takeaway is that a smaller bank focus on past loss, key risk and capital planning to stay financially strong. So I hope this is clear now. What are the methods used by a smaller bank? Because I told you that ICAAP documentation depends on the, it varies from bank to bank, depends on the activities taken by the bank. For a smaller bank, the first thing they do is look at the past losses, they look at the key risks, and finally they do the capital planning. Now let's talk about the bank with moderately complex activity. Let's see what they do for ICAAP. So now imagine a bigger bank that offer loan, investment and trading activity. The risks are more complex, so ICAAP become more detailed. So first thing they do is the major risk identification. Means what? If the bank work with the operational team to list all major risks. So we can see clearly written operational team. They consult the operational team to list all the major risks. For example, if a bank trade stock, suppose a bank is trading a stock, right? So it must consider the market crashes as a risk. Now second thing they do is the loss estimation and stress testing. Two things are there. One thing is loss estimation and second thing is called stress testing, right? So let's talk about it, what it is all about. You know that the bank uses past data to estimate possible losses and apply stress test to see how bad things could get. For example, what if a sudden economic downturn caused 20% of loan to default? Obviously it can cause, right? Suppose a sudden economic downturn happen, and because of this downturn what happened, that 20% of loan default, 20% of loan got default. So that is called loss estimation, right? The bank use past data to estimate possible losses and apply stress tests to see how bad thing could get. And then the third thing they do is the checking the capital adequacy. right? It means that bank analyze whether it has enough capital to handle identified risk. First thing, what are the first thing they do? They look at the major risk, identification of major risk. Second thing, they loss estimate, right? That means what if a sudden downturn causes 20% of the loan to default? That is called, they use the past data, use historical data, past data to estimate possible loss, right? And the third thing they do is the capital adequacy checking, which means bank analyze whether it has enough capital to handle the identified risk. Why it matters? That is why it matters, because to avoid financial crisis and regulatory penalty, right? So capital requirement analysis is needed to avoid the financial crisis and regulatory penalty. And then the fourth thing they do is to estimate the additional capital need. What it means? It means that if some risks are not fully covered, the bank calculate how much extra capital it should hold. You know that some risks are not fully covered, right? So then in that case, bank should ask that how much extra capital is required. Is there any requirement of extra capital, right? How much extra capital is required? For example, a bank lending money to a startup may need more capital than one lending to a government project, obviously. So these are the four steps which you have just seen. Now let's move to the fifth step. We are dealing with the medium risk, moderately complex activities bank. Now the next thing they do is to deal with the uncertainties, inaccuracies, or we can call it uncertainty. So what it means? It means that the bank factors in inaccuracy caused by management error or miscalculation. Why? Because human error and unpredictable market can impact risk models. And the sixth thing they do is the business and capital projection. It means that bank forecast business growth and capital need for the next 1 to 5 years. For example, if it plans to expand internationally, does it have enough capital to manage risk in a new country? Okay, so this is the sixth thing they do. And the seventh thing they do for moderately risk activity is regarding the preparing for economic downturn. So when I say adverse scenario, it simply means economic downturn. This is the seventh thing they do. So what it means? It means that banks simulate worst case scenario. You can see clearly written here, adverse economic scenario, or you can also call it worst case scenario. So what does bank do? That bank simulate worst case scenario like recession, inflation, or a banking crisis and plan how to handle them. And finally, in the eighth thing, they do the detailed reporting and review. It means banks submit a formal ICAAP report to senior management and review it estimate through back testing. So what they do? So the bank submit a formal ICAAP report. The report, which is the formal ICAAP report, to whom? To the senior management, to the top management or the board of director. So bank submit a formal ICAAP report to the senior management and review its estimate through back testing. So back testing is used to review the estimate. So the key takeaway is that larger bank conduct detailed risk analysis, stress testing, long-term capital planning to stay resilient. So what we learned in this particular slide, that a smaller bank focused on past loss, major risk, and Basel basic capital planning. Let me write it down. So if we talk about the small bank, they look at what? They look at the past loss. What were the past losses, right? Historical losses. What are the major risks? And the third thing, they look at the basic capital planning. Now if we talk about the larger bank, bigger bank use stress testing, advanced risk model, and long-term projection, and ICAAP ensure that bank stay financially secure even during crisis. So I hope this breakdown make your BFM examination understanding clear. Now let's talk about the next point that we have, next topic that we have. It is regarding the ICAAP to be a forward looking process. So what it means when I say forward looking process? See, imagine you are driving a car, but instead of looking ahead, you only focus on the rear view mirror. Sound risky, right? Well, bank can't afford to make that mistake. They need to plan not just for today, but also for the future. And that is exactly why ICAAP follow a forward looking approach. Now, thinking ahead. So a bank financial stability is not just about today's risk. It is about future uncertainties, right? You can see it is all about the future uncertainty. So ICAAP help bank stay prepared for expected challenges. So it help bank stay prepared for what? Expected challenges. What is the meaning of expected challenges? You know that it includes like economic changes, right? Let me give you an example. When I say economic changes, what I mean, right? It includes strategic planning, economic changes, and macroeconomic factor. So what is strategic planning? Strategic planning is expanding into new market. So suppose you want to expand into new market, that is called strategic planning. And unexpected, there is something called unexpected crisis is also there. That means like a financial downturn. So it's like a business planning for both sunny day and rainy day. Now let's first talk about this capital strategy, right? how it is forward looking, that is what we are looking at for capital strategy. Why bank need a solid plan? A bank's capital strategy is like an emergency fund. So this capital strategy is like an emergency fund. It is like an emergency fund. It ensures that the bank has enough resource to survive financial ups and downs. But how do they decide how much capital they need? Right, obviously capital act like an emergency fund, you know it very well, but how to decide how much they need? So the first step is that understanding risk. Right, the first step is to understand the risk. Then setting capital goal. Let me show you, just wait a minute. Capital strategy, how they do. I think the steps are there. Yeah, so they first of all understand the risk. Then what they do, they set the capital goals. Bank analyze all possible risk. Then they set the capital goals, and if the bank expand, will the capital still be enough? They plan for the growth, and they create a backup plan for unexpected shock. Then the second thing they have is the board approved capital plan. What it means? It means that every bank must have a detailed capital plan which is approved by the board of director. This document answer key question like how much capital does the bank need, how will the capital be used, what capital level should be maintained, what are the capital limits, what is the backup plan. So think of this plan as a GPS for bank financial journey. It helps them navigate safely through risk, opportunities and challenges. Now what happens if things goes wrong? And that is what we call as contingency planning. So you can see capital consideration, these points are included, right? Anticipating all these things. Now what if obviously contingency plan is there? You know what contingency plan, right? So even the best laid plan can go off track. That is why bank need a plan B. So this contingency plan is nothing but a plan B, right? So why need the plan B? They need plan B for when things don't go as expected. What if the economy crashes? What if the customer default on loan? What if the interest rate rise unexpectedly? So bank create contingency plan to handle these surprise without collapsing. For example, if a bank suddenly face huge loss, it may raise extra capital or cut back on risky lending to stay financially stable. So what is the big takeaway? It is that bank must plan for the future, not just the present. Bank create a capital strategy to ensure they have enough financial strength, and the board approved capital plan help bank stay on track, and contingency plan protect against unexpected financial shock. Now let's talk about the next topic we have. We know why it is a forward looking process. Then it has the next topic we have, it is a risk based process. ICAAP to be a risk based process. So why one size fit all does not work in banking? The risk based ICAAP approach, right? Imagine you are setting aside emergency money for your future. Would you save the same amount whether you have a high paying job or an unstable one? Of course not. You would save more if your income is uncertain, right? While will bank do the same thing with capital? They adjust it based on the risk level, and that is exactly what ICAAP risk based approach is all about. What I am told you, that imagine you are setting aside emergency money for your future. Would you save the same amount whether you have a high paying job or an unstable one? Of course not, because you would save more if the income is uncertain. So that is what bank also do. Bank adjust capital based on the risk level, right? Bank adjust capital based on the risk level. So let's talk about capital and risk first. The perfect balance. Bank can't just decide the capital level randomly. They must align them with the risk profile. That is what it is talking about. The bank must align capital with the risk profile. Right. The riskier the business, the more capital that is needed. Right. So it is clear that higher risk, higher capital required. For example, a bank lending to a startup, right, and high risk business, it need more capital, and low risk, low capital. For example, bank investing in government bond may not need as much capital. Think of it like seat belt in a car. The faster you drive, the more safety measure you need. Then the second thing is to setting the capital target. You know that one size not fit all. Bank operate in different environment, facing different risks. That is why their capital target should be customized. So this is called customization of capital target, right? So first thing is that you have a small local bank. First of all, we have a small local bank which faces fewer risks. Then we have a large multinational bank which faces multiple risks. Then we have a digital only bank which faces high cyber security risk. So just like business plan their saving based on their expense and risk, bank must carefully decide how much capital they should hold. Now then we have a sound ICAAP. You know that for ICAAP to be effective, bank must identify and assess every major risk they face. Like they face the credit risk, market risk, operational risk or reputation risk. Then we have something called measuring risks, number versus judgment. That is called quantitative versus qualitative assessment. That is called measuring risk. So bank don't handle all these risks the same way. Some risk can be measured precisely while others require expert judgment. So for measurable risk, if we talk about the measurable risk or quantifiable risk, just like we talk about the credit risk, just like we talk about the market risk, these are the measurable kind of risk. So for measurable risk, a bank use mathematical model and stress testing. That quantitative measure means mathematical model and stress testing. And for hard to measure risk, that means for less readily quantifiable risk, hard to measure risk like reputational risk, strategic risk, banks rely on expert analysis and proactive risk management, right? So for example, a bank can calculate potential loan default but can't put an exact number on how bad press might hurt its reputation. So question is, why proper documentation is crucial. You know, all these assessments must be properly documented in ICAAP report. A well structured ICAAP document help bank. First, they should help bank in setting the quantifiable risk, so regulators and investors that bank is well prepared for the risk and improve internal decision making. So what is the key lesson here? That bank must link their capital to their risk level. Not all risks are same. Some need numbers, some need judgment, right? Quantifiable, non-quantifiable, quantitative. That is what I'm talking about. ICAAP ensure that banks are prepared for both predictable and unpredictable risk. And you know that proper documentation is essential for transparency and decision making. Now let's talk about ICAAP, the next topic that we have. So the next topic we have is ICAAP to include stress testing and scenario analysis. Obviously, let's discuss it. So friends, imagine building a house. Would you wait for a storm to hit to check if it is strong enough? Of course not. You test it you test it under extreme condition beforehand, right? Well, bank do something similar with their finance. It is called stress testing. You know, bank face unpredicted kind of crisis, right? So let me write it down. This is the keyword. Bank face what? Unpredicted kind of crisis, right? Some market crashes, loan default, liquidity crunches. So stress testing help them prepare for this worst case scenario. So the keyword here is worst case scenario. That is what stress testing help them. So what if interest rates suddenly rise? What if customer withdraw large amount at once? What if a major borrower default? So banks simulate this situation to check if they can survive or not, right? So that is called periodic stress testing. I hope this make you concept clear. Now then, second thing we have understanding extreme exposure. Bank don't just take normal risk, they analyze extreme but possible event. Like what if the stock market crashed 30% overnight? What if a cyber attack shut down online banking? What if a real estate crisis reduced loan repayment? Think of it like a car crashes test. Better to know weak points before an accident happen, right? So that is called understanding extreme exposures. So ICAAP, you know, covers all big risk. For stress testing to work, ICAAP must identify all major risk in a bank. What are the kind of major risk? Like credit risk, market risk, operational risk, interest rate risk, liquidity risk, right? Now, you know, different banks are there, and obviously different approaches are there. I know we have talked about it, like for a small bank, we have talked about it, right? So the qualitative and quantitative measurement. So a small bank may focus on local economic risk, multinational bank focus on large economic risk, right? Quantitative and qualitative approach in ICAAP. What are the measurement of how do we measure risk? Let's talk about it. So imagine you are planning a road trip. You check the Google map for the best route, but you also ask an experienced driver for advice on road condition. So that is experience and judgment. Bank do the same when managing the risk. They look both the number as well as an expert judgment. So why do bank use both number and judgment? You know, because bank face many kind of risk: loan default, market crash, cyber fraud. To prepare, they use number and data, which we call quantitative method. So whenever I say quantitative, I mean to say number and data, and whenever I say qualitative, I mean experience and expert judgment. So number give accuracy, but judgment gives wisdom. That is the point. So now let's talk about the power of number. That is a quantitative approach. Let's first discuss the power of numbers. Here it is. So quantitative approach. Let's first discuss it. So friends, you know that banks love data and statistics to predict likely outcome for budgeting. You can say they focus on likely outcome for budgeting. That means how much profit will we make next year. Forecasting. That means will interest rate goes up. Performance tracking means how is our loan portfolio doing. But number only predict normal situation. What about unexpected crisis? Obviously, you know, bank is exposed to crisis. What about the unexpected crisis? So example, bank used financial model, but those model didn't predict the 2008 financial crash. You know about this 2008 financial crash? Number can't predict, right? So then we have preparing for the unexpected, right? That is called stress testing and scenario analysis. So numbers are not enough. That is why banks simulate worst case scenario. right? Like what if market crash 40%, what if a major company default, what if there is certain cyber attack. So these help bank prepare for rare but high impact risk. So let's talk about the risk aggregation. What is this meaning of this term risk aggregation? It means seeing the bigger picture. Bank don't just face one risk, they deal with many risks at once. So risk aggregation means looking at all the risks together. As the name itself suggests, you are looking at all the risks together. Credit risk, market risk, liquidity risk, all the risks across all department and branch of the bank. Just like a football team does not rely on just one player, bank need a complete risk strategy. So why do bank need both number and expert judgment? Number give precision but can miss extreme event. Expert judgment give help where data falls. Bank must prepare for all risks combined, not in isolation, right? So here is an illustrative example of an ICAAP document. Let's talk about it. So yes, what exactly is ICAAP document? Let's talk about it. So ever wondered how banks stay financially strong even in tough time? Well, they have a sacred weapon, a special document that acts as an financial health report and risk control strategy, which we call an ICAAP document. Think of it like a bank self-check report. So let me write it down. So super important point. Self-check report, ICAAP document. So what it does, it identifies the risk, right? What could go wrong? It plan risk mitigation, right? Assessment of risk, risk mitigation, and calculate the capital needs. So it is like a fitness tracker for bank. It monitors their financial strength and keep them prepared. Now, so what it includes, three things. We're talking about assessment of risk, mitigation of those risks, and capital requirement for those risks. And now the next question is why this document is so important. You know that it helps the board of the bank understand the financial risk, right? So you can see to apprise the board come to know that what are the kind of risk it face, and it explains to the RBI how the bank is managing its capital. So it keeps the board informed about what the risk bank is facing and keep the RBI informed that how it is how the bank is managing its capital. It further ensures that bank has enough fund to survive bad times, right? So capital adequacy process. Just like a business create a budget to handle unexpected expense, bank use ICAAP to plan for financial shock. Now, if we talk about the purpose, you know why this ICAAP document is needed. Now, the next pertinent question is approval and format. So, friends, you know that it must be approved by the board, right? Bank board must approve it. It is not just another internal report. It is a legally important document, and obviously it should be easily understood, easy to understand. Senior management should be able to read it and take action. Now it should complete information should provide, all information should be provided, that it contains all the necessary detail about risk and capital need. So think of it like an investor pitch. If the number are not clear, no one will trust the plan. Then we have some technical information or technical side, how bank measure risk. You know that the documents include something called risk management models. Here you can see clearly written risk measurement model. So how bank calculate risk? It includes capital model. Capital model means what? It means how bank decide how much capital to hold. It includes profit and validation, means minutes of meeting, external review, board's approval. Imagine submitting a business plan, you need supporting document to prove your number. Similarly, bank provide validation in ICAAP. So the final wrap up, why is the ICAAP document so crucial? Because it tracks the bank risk and financial stability. It guides the board and RBI. It ensures that bank stay prepared for financial ups and downs. So I hope this make your concept clear. Now let's talk about the background. So ever wondered how bank analyze their financial strength and future risk? It's all start with background data, a deep dive into their finance, capital and risk appetite. So first of all, let's talk about organization data. What is inside the bank financial report? You know that just like company maintain financial record, bank do too. So what they track? They track the something called group structure. They track a group structure, means how the bank is legally and operationally set up. How the bank is legally and operationally set up. That is called group structure. Second thing they do is to look at their historical financial data, means profit trend, taxes, dividend. They look at it. What is the operating profit? What is profit before tax, profit after tax, dividend, etc. They look at the shareholder fund. This is the background, means how much capital the bank hold versus what regulatory required, right? The next thing is deposits, means money held by customer and other bank. Total asset, means a full picture of everything that the bank own. Trends, it means patterns in data that predict future financial health. So think of is like bank health checkup, where past financial performance help forecast the future. That is what is happening, right? Now then we have summary of current and projected financial and capital position. So bank don't just plan for today, they strategize for future. So we have the current capped financial status. How strong are we today? That means what are the expected change, what changes are coming in the banking industry, what is our future roadmap, how much capital will be needed, what happen if the things goes wrong. It is like a company planning its budget for the next 5 year, right, preparing for both goods and bad time. Then we have capital adequacy. How much backup fund does a bank need? That's called capital adequacy, right? How much backup fund a bank will need. So bank can't just operate on luck. They need to ensure they have enough capital to survive tough situation. So what do they check? So to ensure it, they check the risk appetite. It means how much risk is the bank willing to take. They look at the capital requirement. It means that is the capital for regulatory compliance or business expansion. So is the capital for regulatory compliance or is the capital for business expansion? So what the capital is used for, whether regulatory compliance or business expansion. Then we have something called economic capital model, predicting risk based on various confidence level and time frame. That is called economic capital model. Confidence level is there, time horizon is there, scenario analysis, testing how much capital is needed under extreme situation. And then we have capital adequacy review. You can see written here, capital adequacy review. It means reviewing if the bank capital is enough at all time. So it is like an emergency fund. Every smart person keep one, and so does the smart bank. So final takeaway is that in the ICAAB background report help bank track their past, analyze their present, and prepare for the future. Capital adequacy planning ensure that bank can handle financial stress and meet regulation, and every bank need to stay ahead of risk to remain strong and competitive. Now let's talk about what are the risk analyzed in ICAAB. Here you can see risk analyzed in ICAAB. What kind of risk are analyzed? Let's discuss it now. So that bank handle massive amount of money, but have you ever wondered how they protect themselves from financial disaster? From loan default to market crashes, every risk must be identified and controlled. So let's break down the key risk analyzed in ICAAB. The first risk is regarding the credit risk. What is the meaning of credit risk? What if the borrower don't repay? So bank lend money to business and individual, but what if the borrower fail to repay? That is credit risk. How is it assessed? So bank analyze their credit exposure, who they have lent to, and what are the chance of default. So that is called credit risk. How it is managed? So it is managed through diversified loan portfolio. It is spreading loan across different sectors, setting a strict loan approval process to minimize risky lending. Then we have market risk. That bank invest in stock, bonds, currencies. So if the market condition change, this investment can lose value. So it is assessed using the tool which is called a value at risk, right? So a fancy way of estimating the potential losses. And how to manage it, how to manage the market risk. So we have something called hedging strategy. It means that like insurance for investment, right? So it's like investing in the stock market. A smart investor always diversify. Then we have operational risk. Operational risk, what if the internal system fail? So system error, fraud, cyber attack, things that can disrupt operation. So it is assessed by tracking past loss event. We look at the past loss event database, and it is managed by a strong internal control and cyber security, insurance to cover unexpected loss. Then we have something called liquidity risk, right? So liquidity risk means what? Bank need enough cash to meet certain withdrawal demand. If they don't, it is liquidity crisis. So it is assessed by the LCR. LCR is called liquidity coverage ratio, a measure of available liquid fund a bank has. And how it is managed? It is managed by keeping high quality liquid asset. What is HQLA? We have talked about it. HQLA, high quality liquid asset the bank maintain, right? So this is a method of managing this liquidity risk and ensuring balance between loan and deposit. So I hope this make you clear how market risk is measured, how they are mitigated, how to manage this, how operational risk is measured, how they are mitigated, how credit risk is measured. So tell me, how credit risk is measured? It is assessed by bank analyze the credit exposure. Credit risk, credit exposure. How market risk is measured? By using VAR model, value at risk model, right? Then we have operational risk, how it is assessed by past loss event. Liquidity risk, how it is assessed? It is assessed by LCR. You must know it, right? And how to mitigate them? So how to mitigate the credit risk? Tell me, how to mitigate the credit risk? Credit risk mitigation by diversifying the loan portfolio. Then how to eliminate the market risk? To manage the market risk, we should have a hedging strategy, right? We should spread investment across different market. Then how to hedge the operational risk? So we should have a strong internal control and cyber security, and we should have insurance. How to mitigate the liquidity risk? We should have SQLA, high quality liquid asset, right? Like cash and government bond. Now the next kind of risk that bank face is called concentration risk. It means that if bank invests too much in a company, sector or region, the problem arises. And how it can be assessed? By setting the exposure limit. We look at examine the exposure limit, right? Then we can get whether it is facing concentration risk or not. And how to manage it? By diversifying our portfolio, by diversifying investment across industries and region, right? And avoiding over reliance on a single income. So imagine betting all your saving on one stock. Then we have something called interest rate risk. So interest rate risk, you know it very well, that when bank earn money by charging higher interest on loan than what they pay on deposit, but if suppose rate change suddenly, so it affect profitability. That is called interest rate risk. How is it assessed? How to assess interest rate risk? To assess the interest rate risk, we use gap analysis. This is super important thing. This is super important. How do we assess interest rate risk? We use something called gap analysis, right? So using gap analysis to track the difference between earning and borrowing rate. And how to manage it? Using interest rate swap. If you have to manage the interest rate risk, we should use interest rate swap. Can you tell me how do we manage market risk? By using some hedging strategies and by diversifying our portfolio across different market. How to mitigate, how to manage the interest rate risk? By using something called interest rate swap, or by adjusting loan and deposit rate based on market trend. Then we have some other risk, like you can see residual risk of securitization. So you know what if the loan bundle, you might have heard of MBS, right? Mortgage backed security. This is a kind of loan bundle, right? So what if the loan bundle does not perform well? So it is managed by stress testing and capital buffer. You have capital buffer, you have a stress testing. This is how you should manage the residual risk of securitization. Then we have something called a strategic risk. What if the bank strategy does not work out? It is managed by market aligned planning. You can see clearly written. Then we have something called reputational risk. So business risk. What if the bank loses customer or profit drop? It is managed by flexible business model. Then we have something called reputation risk. It means what if the bad publicity damage trust? Suppose bad publicity is there and it damages our trust. That is called reputation risk. You know about it. So it is managed by proactive communication. You should proactively communicate. Pension obligation risk. What if the bank can't meet pension commitment? So it is managed by proper funding. Other residual risk. Any other unidentified risk. It is managed by ongoing risk assessment. So the bank face multiple risks daily, but through ICAAP they identify, assess and manage those risks effectively. From loan default to interest rate change, every risk has a strategy in place. That is what we have learned now. So we got to know that what are the risks that a bank face and how it is managed, how it is assessed and how it is managed. Now let's talk about risk assessment and quantitative result. So ever wondered how bank makes sure that they don't run into financial trouble? They don't guess their risk, they measure them. In this particular slide we will break down how bank assess risk, right? So you know the first thing is risk assessment is not a guesswork, just numbers. So bank don't just assume that they are safe. They use quantitative models and a stress test to calculate risk with precision. How it is done? So you know there is something called a stress test. So a stress test check how the bank would survive in extreme situation. Each risk, credit, market, liquidity is tested to see its impact. And where all this documented, how the documentation is done. So in the report called ICAAP internal capital adequacy assessment process, this is a report. In ICAAP report it records every detail, that whatever stress test we have done on different kind of risk, right? We detailed results are written here, right, or documented here. Now let's talk about mitigation of RBI highlighted risk, that how to fix the risk highlighted by RBI. You know that RBI conduct on-site inspection. You know it very well that on-site inspection are conducted by RBI to check if the bank is managing risk properly. If they find any weakness, the bank must fix immediately. So how do the bank respond in such situation? Suppose RBI find any weakness, obviously bank should respond. So how do bank respond? So increasing capital buffer. You can see clearly written here. So bank respond by increasing the capital buffer. It means extra fund to absorb unexpected loss, and strengthening the risk control. It means better fraud detection system. So imagine an RBI inspection like a surprise audit at your workplace. If there are gaps, you need to fix them fast to stay compliant. Then we have something called CRAR. You know CRAR? CRAR means checking capital strength. So what is CRAR? CRAR stands for capital to risk weight asset ratio. You know it very well. So a fancy way of saying how much capital a bank hold compared to a risky asset. So question is why it is compared? Why the CRAR is compared? So you know RBI has its own way of calculating CRAR. Bank also calculates CRAR under ICAAP. If there is a big difference, the bank need to adjust its capital strategy. So RBI assess CRAR is there and bank assess CRAR is there, and then both are compared. And suppose if there is a big difference between bank calculated CRAR and RBI assessed CRAR, then what bank do? Bank need to adjust its capital strategy. Think of it like two people checking your weight, one with weighing a scale and other using estimate. If number does not match, you are a double check, right? So you should be double check, right? So that is what is happening, that RBI also calculate the CRAR, bank also calculate their CRAR, and if the gap is too high, then in that case ICAAP, right, the bank need to adjust its capital strategy. Now the next question is risk appetite articulation. So the first question is, what is risk appetite? You know, what does it mean? A bank decide how much risk it is willing to take in different area: loan, investment, market trade. How is it defined? You know, bank set clear limit for each risk. So you can see the word written here, clear limit. Bank set clear limit for each risk. For each risk they set a clear limit. This help ensure that risk taking is balanced with financial stability. Think of it like setting your own spending limit. You decide how much risk you can afford, whether to spend more on stock or keep money safe in a saving account. Now let's talk about beyond capital. Beyond capital, other risk management methods. You know, capital is not the only defense. Bank also use something called insurance. You know it very well. In addition to the capital, bank use insurance, hedging, diversification, right? So these are employed. Insurance to cover unexpected financial loss, hedging using financial instrument, diversification, you know, that is spreading investment to us so as a single failure does not cause huge loss. So bank don't just hope for the best, they measure, compare, control risk with detailed model and RBI guideline. From stress test to capital buffer, everything is planned to keep the bank stable. I hope this explanation help you understand the basic concept. Now let's talk about the methodology and assumptions. Very important point. Let's discuss it. So friends, ever wondered how bank decide how much risk they can afford to take? Do they guess? No. There is a detailed science behind it, and today we will break it down in the simplest way possible. So the method behind the magic is how risk are assessed. So bank follow a structured approach, right? It is not about calculating numbers. It is about understanding the risk, making assumptions and running tests. So what does ICAAP consider? So first thing they consider is credit, market and operational risk. These are the big one. Some also consider additional risk capital assessed and added to ensure financial safety, right? The two big approach, how bank measure risk. So the first approach, the two methods here written. The first method is called CRAR calculation. You can see the first method is CRAR based calculation, and the second method, so what they do in CRAR calculation, they start with capital to risk weight asset ratio, CRAR. So this CRAR is treated as like a baseline, right? And then the extra risk capital based on ICAAP detailed assessment. And the second method is internal model, right? Internal model for all risk, means instead of just following CRAR, bank create their own risk model. So this is called own risk model. Bank create their own risk model, right? So these model measure credit risk, market risk, operational risk more accurately. So think of it like checking your health. CRAR is like a basic fitness test, but internal model are more like a full body health checkup. So how does the bank actually calculate risk? So what is the methodology used to actually calculate risk? So there is a step-by-step process. So first of all, they ensure that each risk category is calculated separately, like credit, market and operational. The bank explain why it choose a specific method. So why it is choosing a specific method? This the bank explain. Internal model must use past data and trend to predict future risk. It is just like cooking, right? You follow a specific recipe for each dishes. You know, if we talk about the internal model assumption, internal model quantification, you know, how do bank decide what is risky and what is not? So they make assumption. So there are some key assumption and parameter we are talking about. The first thing they do, they look at the historical data, right? So they fine tune their model based on the past trend. So what are the limitation of these model? You know, every model has a flaw. So first of all, there are some constraint, right? So that is called, the first thing, identify the constraint on the model. This is called model constraint. It means that are there any blind spot? Then we have sensitivity analysis. It means if the condition change, how much does it affect the result? Obviously, how much the result will change if the condition change. Then we have validation test. Do this model still work correctly over time? Think of it like a mobile battery. Over the time, its performance might change. So you need to test and recalibrate it. So bank don't just assume risk level, they calculate them using a specific models, assumptions and stress testing. ICAAP ensure that every risk is measured, understood and controlled. Right. So I hope this helps you understand the basic concept of ICAAP. So that's all for the part 2 lecture. We will cover the rest portion in the part 3 lecture. I hope your concepts are being cleared step by step, and I request you to please go through the MCQ session, and if this video helps you clarify your concept, please like it. Thank you.